Now, let's bring in Jim Bianco. He is the president of Bianco Research. His firm specializes in figuring out the effects of economic data on the markets and what people should do with their money. Jim joins us from Chicago. All right, Jim, so you take a look at the ADP report. You put that together with what happened or didn't happen with oil and stocks today, and then mix in a little bit of that beige book for us. Tell us, what's your thought? There's the closing bell, by the way, Wednesday, March the 2nd, 2011. Tell us, Jim.
I think that the market is having a problem with oil. I guess, did we all forget it was down 160 points yesterday and it barely recovered today? I mean, it's not going to go down 160 points every day that oil goes up. So net, the market is having a problem, I think, with high oil prices. You mix in ADP, you mix in the beige book, and what you find is you find an economy it's doing okay. It's not doing great. Stock prices are up 31% over the last 6 months or so, and that's going to be difficult to support that kind of a rise in the stock market. The economy's better, but not as much as the stock market has leaped ahead.
Well, the stock market leapt ahead or crept ahead once again today. Hang on, Jim. Let's take a look at the closing numbers on this Wednesday, March 2nd. The S&P ending the day with a gain of just about 2 points, or almost 0.2%, 1308. We had also the Dow Jones Industrials gaining by day's end, but again, that gain was minimal, up only 8 points to end the day at 12,066. And finally, the NASDAQ, which has been the leader all day, as Suzanne told us earlier, semiconductors and Apple helping matters there. So the NASDAQ rising about 11 points, 0.4%, 2,748 was the closing number for the NASDAQ. Well, Matt Shapiro is a money manager, trader, and president of MWS Capital. He's joining us now from the Chicago Board Options Exchange. And, Jim's point is well taken. Everybody seems to be watching oil. How do you have an update for stocks when you have an update for oil?
Well,
how does that work exactly?
Well, it's tough to get used to $100 oil, but I think consumers easily make the adjustment a lot quicker than you think. And take a look at this market. You're getting back into these blue chips at very good valuations and with great ISM numbers, great employment numbers. And what I am seeing is a bullish consumer spending environment that's going to carry us through the end of the year. And that's something people aren't taking a look at. And that's why we have all these good industrial numbers ramping up to support these consumers that will spend and will buy cars that are actually going to be able to adjust to higher oil prices.
But Matt, how is this all going to work? Because, of course, we're not only just getting higher oil prices, we're getting higher prices for everything, it seems like. And as we heard from the Fed today, and as we've been hearing from a lot of individual companies, they are passing those higher costs on to us.
But the employment numbers, I think, is the important thing to look at. There's been some forecasts that we may have just 7% unemployment towards the end of the year. People have money to spend. The malls are packed. It's difficult, actually, to find a parking spot in the malls on the weekend. So I think at the end of the year, people will find that consumers have a lot more to spend, and actually higher prices are increased demand and not a monetary phenomenon of higher inflation.
Hey, Matt, it's Dominic here, though. But doesn't that fly right in the face of those personal spending numbers we saw just come out this past week? Less than half of what economists thought. Are people really out there spending their money?
They really are. That was a heavy winter here in Chicago and the Northeast. People weren't out. This last weekend, it was impossible to do anything. I was out there buying my kids some stuff in the malls. They were packed. Couldn't even find a parking spot. The best deal was $6 for a valet right in front of Nordstrom's.
All right, Matt Shapiro with the mall shopping parking lot indicator. Excuse me. We're going to bring it back to the Fed now. Listen up. We heard from PIMCO co-CEO Mohamed El-Erian. He talked to Bloomberg Television earlier today about the rise in oil prices.
If oil prices go further up, if this oil shock persists, then Mr. Bernanke will find it very difficult to control overall inflation. He's going to have to accommodate some of this oil price shock because the economy is so weak.
Jim Bianco, you heard what Mohamed El-Erian said. So what do you think? I mean, oil price shock, or we just forget about it?
No, it's an oil price shock. I mean, we forgot here that the real price of oil is more along the lines of where Brent is at $116. Once the Cushing oversupply situation rectifies itself, that price is going to drift up to 116. So let's all put in our mind that the price of oil right now is $116, was 120 last week. It's going higher. It's going to be a problem for the Fed. They are printing money. We have monetization going on, and we have higher inflation expectations. All these things are going to come together, I think, later this year, maybe this summer. Higher oil prices, the Fed's QE2, which I think is printing money, and it's going to be problematic for markets because they're going to be worried about inflation and they're going to be worried about growth. Growth is there, but it's not there to the level that these markets have boomed ahead. Bernanke himself is taking credit for this rally by saying that it's all QE2 inspired. I think he's right. It is QE2 inspired. And when that ends this summer, we're going to have problems. But right now, it's not summer. It's still 20 degrees outside. We're still printing money through the Fed. The market will keep going higher.
And have you been in a mall parking lot lately, Jim?
Yeah, I've been in the mall parking lot, and I've been in the same mall as Matt, and I know which one he's talking about. That one was full in 2008, too, when the markets were falling apart.
We've got a Teflon mall, apparently,
Well, let me respond to that because we are back in the investment markets to those levels. Those are some of the strong technical indicators. Small mid-cap stocks at highs, and my clients' accounts are at their all-time highs.
So, Matt, what does happen when QE2 goes away, though?
Well, I think the Fed is definitely playing a monetary high-wire act, and I do agree with Jim. You know, it's going to take a long time for us to realize that we are spending way too much more, and the Fed borrowing levels, the Treasury rate at 3.6% for a 10-year is just way too low. And we're going to have to come to grips with the fact that the Fed is going to have to, the Treasury is going to have to borrow money at 4 to 4.5% on a 10-year over the next several years. But I think that is a financial adjustment, not an inflation adjustment to the economy.
So, gentlemen, what happens? Do we just grow our way out of this? I want to bring Adam Johnson from our markets desk in on this. Now, Adam, a Jefferies industrial analyst met with Caterpillar's chief executive. The U.S., he said, is still lagging, but overseas, things are doing pretty well.
Yeah, well, this is Steve Volkmann, pretty widely followed industrials analyst, sat down, as you say, with the CAT CEO. And here's the deal. He actually ups his target on Caterpillar because, says Steve Volkmann, all the growth that you've seen in Caterpillar, and by the way, the stock's come roaring back over the past couple of years, all the growth has been in the emerging markets. He says if you look at U.S. sales are still only 50 to 60% of peak, which suggests there's a lot more capacity in the system. As a matter of fact, if you look at factory utilization here in the U.S., it's kind of a similar story where it's 76%. We've averaged like 81%. So he says with all this spare capacity, you got to expect that the U.S. comes back and you start making some more money on CAT. Again, he ups his target, but I don't know, Jim, read through all the optimism for us. Is it really fair enough to think there's enough underlying demand growth here in the U.S. to make up that capacity and then you get a kicker, or are we just whistling past the graveyard and trying to be too bullish here?
I think it's going to be tough because if you look at a lot of the numbers, they underlying them, you have problems. Auto sales numbers. There was a story in the New York Times, I think, that was accurate yesterday that said you can explain that by the return of financing. Not that people want the cars, not that the growth is there. It's just that cheap financing is back, and that's what's driving those. If rates go to 4.25%, that puts a damper on it. If rates go up again and puts a damper on housing, CAT's going to have a hard time selling earth-moving equipment to make roads if we're not going to be building houses and not having subdivisions as much as we have in the past. So these numbers are not bad. I don't want to say that we're going into recession or anything. It's just that we've had a big advance in markets, and I don't think that the economic fundamentals support that advance. It's been largely held up by the Fed, and it's been held up by a lot of other government intervention, and when that goes away, I think these markets struggle.
Gentlemen, I'm curious what both of you are advising your clients to do in this environment. Jim, with you on the less optimistic side, are you advising sort of defensiveness here?
I've been advising that this has been a trading environment. I think buy and hold is a dead strategy. It has been for many years. If you buy and you hold long enough, you'll make no money. You have to buy first. You have to trade in and out. Now, trade might be 1 or 2 times a year. It might be several times a year. Right now, I'd be long the market. I'd be long the market till we get closer to the end of QE2, and then I'd be short the market.
Hey, Jim, let's give you, or I should say, Matt, 20 seconds. Tell us what you're telling people.
Well, I'm a classic buy and hold money manager, and my rate of return over the past 5 years was 4% ahead of the S&P 500. Not that it's going to necessarily continue, but just by buying classic stocks that pay dividends and have high coverage in the economy, I'm continuing that strategy. High diversification, stocks and bonds is going to be a winner. I think Dow 12,000 is going to be just as good as Dow 10,000 a couple years ago.
I love it. A little healthy debate. Thank you so much, guys. Jim Bianco and Matt Shapiro, both of you joining us from different places in Chicago. Thanks.